You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back with episode 2 of our by-episode doubleheader out here, coming at you 2 episodes back-to-back for all of our pro folks hanging out in the live. You get to hear them right away for all you folks on the on-demand side, and we know you are Legion. The second episode will be hitting you in a couple of weeks out here on the old feed, so stay tuned for that. My name, of course, Mark Longo from the optionsinsider.com, as well as from the aforementioned network upon which so many of you are binging and mainlining. Maybe some fun new stuff coming to said network. Haven't rolled out a new show in a while, so maybe we'll experiment with that. No promises, just some ideas in the offing out there, so stay tuned to the network. Could be some fun stuff. There's always fun stuff every week, but even more fun stuff coming at you sometime in the near future. Remember, if you like what you hear, the fun stuff we got coming at you now, the fun stuff coming down the road, wherever you're listening to this, Audible, YouTube, Apple Podcasts, wherever, Donkey Cart in Estonia, comment, rating, review does help at the end of the day. More people continue to discover the content. Of course, if you hear a show and you hear a sponsor that you say, you know what, that resonates with me, I want to try out their product, and you like it, by all means, let them know you heard about it on the network. That also goes a long way to really helping continue to support the network out there. It's a collective venture at the end of the day. We've been doing this for 17 years. Glad to see so many people like it. But at the end of the day, more ratings, more reviews, more letting our sponsors know you like what they're doing out there. You like the fact that they're supporting the network. All that stuff in aggregate does help out at the end of the day. And of course, if you want even more in your lives, you're ready to go to the next level with your options content, theoptionsinsider.com/pro. The place to go to learn more. Gives you live access to these great double headers, gives you live access to our pro Q&As, gives you access to Options Oddities, gives you access to our exclusive pro podcast feed where we have, 300 some odd, I've lost count, episodes waiting for you the second you hit that button. Some of the best minds in the world of options and derivatives coming in just to answer your questions because we like you folks out there. And then, of course, great giveaways and a whole bunch more. TheOptionsInsider.com/pro is the place to go. Unless you're my cohort, the black-hatted one, he is not invited. Of course, I am talking about none other than Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, a no MTM sign allowed on the door, sir, for you. What do you say?
That is a bunch of crap, Mark. I've been known to crash a party. I'm coming.
I like
don't
it.
care what you say.
Next time we do approach you, Dan's just bursting in. Here I am. What you got?
That's right. That's right.
Kicking down the first you want to join up with next Don Schlesinger thing we do. Now you want to just kick down the door on the pro. I don't know, Dan. You're becoming a bit of a wild card out there.
Yeah. Well, that's how I roll, Mark.
Wild card indeed. Let's see what we got in store for you. Is it wild? Let's find out. A little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody, welcome to the basic training. And today's topic actually kind of surprised me because I had thought for certain we had done a full episode about this subject. And yet when I went back into the archives, I see we've touched on it many times in the past, but never done a full episode, which is kind of surprising to me. So what are we talking about today? This is everyone's favorite stock substitution. Now, if you're saying to yourself, I know you guys have talked about that before, you're right. And if you want to go back into the archives for more looks at all things stock substitution, the most recent conversation we had about it was on episode 246 back on July 19th of last year called Vanishing Volatility, if you want to go look for it. Before that, it was February 2nd of the previous year talking about, that episode was all about gamma squeezes, but we also talked in a little bit of stock sub there. Usually these were in response to listener questions. And then episode 167 from December of 2021. We talked about spreads, rolls, and avoiding end-of-day madness. And in that came a conversation about stock substitution. Episode 105, some of the heady days of September 2020. Hedging crazy markets revisited. Also talked about stock sub there. And then you got to go all the way back to July of 2013 for the next time we talked about it, which was episode 25, using options in retirement accounts. And then a couple more. February of 2013, that year as well, episode 16, Avoiding Earnings Pitfalls with Options. And then episode 12, of December of 2012, we talked about weekly options. So at some point in all those episodes, we touched on stock substitutions. If you want to go back and listen to those, you're a deep, diehard stock sub fan, or if you're doing what a lot of our listeners do, they go back to episode 1 and work their way all the way through. We have remastered episode 1 for that purpose. We might have to go back and remaster the entire feed because you folks are sucking down the archives, which, again, we love to see that. Keep up the good work. But Mr. Dan, A, are you surprised like I was that we haven't really done a full episode on stock substitution? And B, when I say that term to you, I say stock substitution, what comes to mind? What are your thoughts, sir?
Well, you know what I'm mostly surprised by, Mark, is what a fantastic memory you have.
Right off the top of my head, I can list them all. I know exactly the archives, sir.
Jeez, that's pretty darn incredible, man. I don't know how you do it.
Steel trap.
Yeah, it is a bit surprising that we never did an episode on stock substitution. That's pretty amazing. And then, oh, shoot, what was the other question? What's my favorite animal?
Yes, what's your favorite? How are you so incredibly handsome? I just said, are you surprised, pretty much? And also, what are your thoughts? What are your thoughts when I say stock substitution? What springs to mind?
Oh, yes.
I love it. I hate it. This is how I do it. Anything.
I do it pretty seldomly, honestly. I tend to attack either like investing with actual shares or trading with, things with less risk. But yeah, what comes to mind is two things. Leaps, which I think comes to a lot of people's minds. That's the usual one. And then synthetics too. I think we have to add them into the conversation if we're having it, or at least give it an honorable mention for today.
Honorable mention indeed. So let's get down to business. Listener, you mentioned leaps, Dan. This is one of the reasons why this subject came to mind was, of course, our somewhat tongue-in-cheek question of the week that we did back last week as of recording this, 2 weeks ago, now that you're hearing this, of course, listeners, we asked you for Leap Day, how do you use leaps in your options trading? Gave you 3 choices and the infamous other: income, long-term hedges, stock substitution, or other. And 62.5% of you went the stock substitution route. So that is definitely your preferred use case for leaps. One of the reasons why this leapt to mind, pun intended, as a potential subject for an entire episode. But also, you could argue, Dan, if you're thinking about stock substitution, there hasn't been a better time in a long time than there is right now. Markets hanging out at or near all-time highs as we're recording this, listeners. And that is usually the time when people start thinking to themselves, maybe this might be a good time for a little bit of stock substitution. Take some of that risk off the table. So let's get down to brass tacks right now, listeners. What are we talking about? Let's go out to everyone's favorite I personally have made fortunes in this name. Dan, unfortunately, has lost fortunes in this name. That's just the way this one rolls. This is XYZ. I know Dan gets angry and every time I bring it up. You can ask him why. But XYZ listeners, he's going to hate me after this episode. XYZ trading for $100. You know, all of our examples. Nice round numbers for XYZ. You're looking at 1,000 shares in your back pocket of XYZ that you own. So you're sitting on $100,000 worth of XYZ right now. That's a lot of capital to have at risk. Maybe a couple of things have happened. Maybe XYZ is like the markets right now, and it's been on a bit of a rally, and you're saying to yourself, you know, I don't know, maybe this thing is going to peter out for a little bit, or maybe you're looking at XYZ in long term. You know it's going to be up over the long term, but maybe in the near term, maybe some storm clouds are on the horizon, and maybe you might end up giving back some, or maybe a decent chunk of that out there. For whatever reason, you're long a bunch of this underlying, and maybe you have some near-term concerns, but you still want to have some skin in the game because you never know. Maybe it's FOMO. You think it's going to become a GameStop. You don't know if it could have another up leg in it or not. So you want to be there to have some skin in the game in case the best case scenario comes to pass, but you don't want to have all the skin in the game in case the worst case scenario comes to pass. That's where the stock substitution comes in. So what are we talking about? Well, first off, before you even get any farther, you're in that scenario. You have a couple of options, obviously, pun intended. First off, you can just sell the stock. That is perfectly acceptable. Take your profits, live to fight another day, maybe put them into an underlying that you're more comfortable with. Or B, you could buy a put to hedge it. We've talked about that a million times on this show. There are pros and cons to each of those. The put's going to be expensive, but it will stop you out at whatever level. Then you can sleep at night, but you've also paid a lot for that privilege. So that's two ways you can go out there, listeners. And then, of course, what we're going to talk about today is the stock sub. So what are we talking about here? In the scenario for a stock substitution, you're usually going to, as the name implies, sell the underlying and then replace it with a call option in this example. Now, the way these are set up, they usually tend to revolve around longer-term, meatier, higher delta call options because you want to have something that's going to approximate a fair amount of the deltas of the underlying. Doesn't mean you have to go all the way to 1. You don't need a full 1-to-1 replacement for the stock, but you want to get close. So you're probably going to go north of 50. You're going to go in the money from an options delta perspective, an options expiration perspective. So in this case, we're going to sell our stock at 100. Now, there's obviously tax considerations there. So if you don't want to take a tax hit, this strategy is not for you. And then you're going to buy, again, usually somewhere in the 6-month to probably 1 year range, and it depends on each person you're going to talk about. Probably somewhere, I would like to say ballpark, at least 65 delta call. So in our example, you have 1,000 shares. You're going to have to buy 10 of those calls to approximate the 1,000 share position. In our example here, you sell the stock for 100. You buy 10, 1 year. So you're going pretty far out. 80 strike calls. So these are 20 handles in the money. In our example, you're going to pay $30 for those. So now you've sold your stock. You put $100,000 into your account. You spent $30,000 of that back, so nearly a third of it, to keep this position going. What have you done? What are the first benefits of that? Well, the first one is obvious. You just freed up $70,000 in capital. You have a position that approximates a lot of that underlying position, but you know what? You got $70,000 to do with whatever you want. If you're concerned about the overall market, you can put that in your mattress and you can sleep well at night. You can go put it in T-bills. You can go put it in another stock that you have maybe more optimism for. So that is the first and, quite frankly, a very big benefit. There's a huge opportunity cost to not doing this trade because now you're taking capital you could do and for now have multiple positions instead of just one. So that is a huge benefit of the stock substitution. That's what frees a lot of people in term mentally. It's just a certain psychological freedom that comes with taking all that risk off the table. And now you know I'm not going to lose $100,000 if the stock goes to zero. Worst case, I'm only going to lose 30. Only in air quotes. Still a lot of money, but not as bad as it could have been. B, the second benefit. You're going to put the Greeks in your back pocket. They're going to work for you. Dan's written a whole book about the Greeks. But if you're buying this, if you're swapping a meaty option position for the underlying, guess what? You now have Greeks working for you, where with you have stock, you really only have one. You have delta, and it's a 1. It doesn't change. You have no gamma, you have no vega, you have no theta, none of that stuff. Now, if you're going into the options front, now you're swapping in some Greeks that could kick in to help you out. For example, you bought a 65 delta call versus a 1 or 100 delta stock position. So if the stock goes up, you're going to miss out on some of those gains in the near term. But as it keeps going up, that delta is going to get closer to 1, and you're going to make up on that ground. Pretty soon it's going to be effectively like stock. But to the downside, if the stock drops, guess what? You're losing less money with every tick, roughly 65 cents. The more the stock drops, obviously, too, the lower that delta is going to get. So as the worst case scenario starts happening, stock starts dropping, you're going to lose less money with every tick of the underlying. So that's a nice thing. It's called gamma. It's your friend in this scenario. As Dan pointed out earlier, there is some time decay on this. So in this example, we paid 10 grand extra for the privilege, the premium of buying this call. So something to keep in mind that could erode over time if the stock just sits there. So that is a negative in this case, but also you have the gamma and you also have vol. Vol kicking in to be your friend as well. Remember, if the worst case scenario happens, stock starts selling off, not only is the delta going to decrease, but your rate of loss is going to decrease. But guess what's going to happen to your vol? This is a long-term position, a lot of vega in this. So the vol is going to increase. That's also going to offset your rate of loss. So you have most of the Greeks working for you, whereas if you just have stock, you just got one and it's delta and it's just going straight down. So there's a lot of benefits and pros to having this here. And then, of course, the third benefit is if the best case scenario does happen, stock continues to take off, you're going to participate on most of that, which is nice. So you don't have to worry about missing out that FOMO that everybody seems to have right now. All right, Dan, I broke down a lot of the pros and cons here for mostly pros for the stock sub. A lot of it revolves around the Greeks. You are the guy who wrote the book on the Greeks. What are your thoughts about the Greeks when it comes to stock substitution and their efficacy or perhaps lack thereof, sir?
Well, it depends on the use case because, I mean, if you just look at the mile high view when it comes to looking at the Greeks, I mean, in theory, everything sort of offsets each other. The benefit that you described of having positive gamma, which is definitely a benefit, is offset by having negative theta. Now, because the options are so long-term, the gamma is pretty low. The delta doesn't change that much. You could see that by observing an option chain and just look at, the delta's 10% away. They're almost the same as they at the money for most stocks. And consequently, the theta is pretty small too. So it kind of depends on your objective. I mean, one of the most popular objectives is what we would call the poor man's covered call. And that's just simply, hey, look, I don't have enough cash to buy the stock, so I'm going to buy the Leaps call slightly in the money. The at the money is already going to have a higher than 50 delta because there's so much time to expiration, especially when interest rates are at this level. So the benefit that you get of being able to keep that cash in the bank, like Mark pointed out, and earning interest on it is offset by the fact that you lose some time decay on there. And the interest rate ends up showing up in the time decay. That's why there's a difference between the call time decay and the put time decay because of the interest rate component. So, if you wanted a covered call position, but you can't afford the stock, I mean, it's not a terrible substitute. It's not a terrible substitute at all. You pay for that right of having that substitute, but that's okay. That's trading is a business, and in any business you have costs, and that's just the cost for being able to take advantage of this position that you'd never otherwise be able to take advantage of.
All right, we polled our pro members here in the live chat saying, are you guys fans of stock substitution? If so, how do you go about it? Buddy Frank says he's not a fan, hasn't used them. So there you go, like you, Dan. And then we got the Queen. She's one of our regulars out there, not necessarily a fan per se, but she has used them in the past. So there you go, she dabbles. I have sold the stock and bought a 6-month in the money. Yeah, okay, there we go. Option God, he keeps this. He's like Dan. He likes to keep the stock and ride it out. Nichols saying, well, a lot of people think he likes to go the Overby way with the fig leaf. This gets back to what you were just saying, Dan. There are ways to jazz up the stock substitution, listeners. You don't have to just go this plain vanilla route. This is kind of the most basic route. But then the other way to go is what Dan called the poor man's covered call. There's a lot of names for this position. Synthetic covered call. Mr. Overby calls it the fig leaf because you're only partially covered. And this is what Dan was just referring to. You buy the in-the-money longer-term call. Could be 6 months, could be a year, could be 65, 75, 80, 90, whatever delta you fixate on, whatever time frame works best for you. And then you say, that is kind of expensive. As you mentioned in our example, you're paying 10 grand worth of time decay if everything sits there. You might want to do something to offset that. And that's where the synthetic or the poor man's covered call or the fig leaf, whatever you want to call it, comes around. Where you turn around and sell out of the money, effectively quasi, I guess you can call them covered calls out there. Those can be out of the money calls now. Going to get a little bit of premium. You're going to do those much nearer to expiration, probably in the monthlies, if not in the weeklies, and keep doing those week after week, month after month. So over time, as you get out towards the expiration of that call, you've done something to offset that pretty pricey theta you have out there, and maybe even made a little bit of money on top of it. And hopefully you got a little bit of appreciation on the call to help offset that as well. So it's a win-win. The reason why it's called a synthetic covered call or a fig leaf only partially covered is that most brokers, when you buy this long-term in-the-money call and then sell the front month call against it, they're not going to see that as offsetting positions. They're not going to margin you the way you would if you have stock. If you have stock and sell a front month call against it, those two, from a risk perspective, are offsetting. From a brokerage perspective, not so much. And obviously, you have this long-term call in your back pocket. So if the stock takes off, you have that. You could sell or exercise or do what you have to do. Hopefully not exercise. That would be a painful hit. You lose all that 10 grand worth of time premium. But you have that in your back pocket. So in case you have a GameStop type scenario, which is what your broker is worried about, you're not just naked that front month call, which is how they're going to try to margin you. So again, depends on your broker, how savvy they are from an offsetting and risk perspective. Hopefully they won't margin you the full kit and caboodle of one short call. But from the eyes of a lot of brokers, especially ones that aren't as option savvy, in that position, you are going to be net short units, and they're going to margin you pretty onerously as a result. So bear that in mind. If you want to go the fig leaf route to kind of jazz up your stock sub position, it may be onerous from a margin position. It may be worthwhile maybe contacting that broker and saying, hey, you know what? I have this other call against it. Maybe you knock down my margin requirement a little bit. If this thing goes pure GameStop, I do have this call. So it's not like it's a complete free-for-all to the upside. So again, your mileage will vary on that, which is why we didn't get into that here. Maybe that'll be a future episode. We get into some of the nuance. But we'll probably bring on our buddy, Mr. Overby. He's Mr. Figleaf for that. Dan, what are your thoughts? You kind of just mentioned it. What are your thoughts on that upgrade to the stock sub position, adding that covered call, and the fact that there are some nuances there? You're not really covered, and that could be a problem for some brokers.
Yeah, I don't know, man. I think you're starting to get a little fancy there, and some of the benefit that you're getting, you end up getting secretly a little bit more of a detriment than a benefit sometimes. I don't know. I mean, I'm sure there's a time when it might make sense, but I mean, to do it as on a regular basis, I'm not super crazy about it.
Sounds like we need another great debate episode. Bring on the options guy, Dan versus Overby, a fig leaf or not to fig leaf. What do you say? I think I see some going to be a whole McLaughlin group. Just point, counterpoint, hot debate listeners. I think we can make that happen. And we'll bring on Don Schlesinger. He'll be in the background just listening and having fun. All right. So yeah, let us know if you want that to happen, listen. I'm sure Brian will be down for it. But intriguing stuff. We got a little bit of time. Let's squeeze in a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, let's get out to you folks out there. A lot of people talking about the Overby style of fig leaf. Maybe we'll have to bring Brian on, a little bit of point counterpoint. I like that idea. Let's go out to the listeners right now. T-City, first up, he wants to know, he says, I'm pretty much just an out-of-the-money cash secured put seller. I don't go crazy with leverage or get above my skis. Mostly 3 to 5% monthly or weekly puts. He means out of the money, obviously. Rinse and repeat in SPY and some of the mega cap names, and I've been doing pretty well. Anything wrong with this approach? Dan, what do you have to say for T-City? I'm sure a lot of our other listeners in this same boat, they've been writing out the money puts on a lot of these big names, and they're doing pretty well. What do you have to say, Dan? Anything wrong with that approach?
It works great until it doesn't work. Yeah, I mean, I don't know. It's hard to tell. Like, look, I know some very experienced option traders who make it work because they've got plenty of risk guards in place and they only do it with a very small percentage of capital. And, they really get the whole big picture, and awesome, keep doing it. But then I also know some people who are newer, or maybe they consider themselves intermediate traders, but they never really got kicked in the nuts too hard on a trade to date. And they just figure everything's going to keep being sunshine and roses until that one day when you wake up and there's some crazy news announcement and the market's down 10%. And you're like, holy cow, I was making 3 to 5% a month and now 95% of my account's gone. What the hell just happened? So not knowing what T-City's background is, I can't be hard on him or her. Maybe T-City's very experienced, has got it super dialed in, and they have had some of these disasters happen, and they get what the problem can be. And if that's the case, awesome. Keep thinking about risk. And if T-City's newer, then there are things that can go wrong, and you can have highly disparate leveraged losses if you're not careful.
Yeah, I think Dan said it all there. You have to have a plan what to do when it goes wrong. You're telling it in the S&P. Just remember, we were 1,000 points below where we are now just a few months ago. So you could easily see that go back in the other direction. NVIDIA, you don't need me to tell you, it could move quite a bit in the other direction. So be prepared for these, 3 to 5% out of the money puts to suddenly be 5, 10, 15, 20, 30% in the money. And then what's your plan if that happens? That's the only thing I would add here. Yes, definitely. It works until it doesn't. Any long-term options trader will tell you that. So you have to have a plan for what happens when it does. And let's get out here on this one, Dan. It's kind of a fun one, kind of a silly one. This is for you. This comes from Slady, I guess. Slady, Slatey. Let's go with Slady. They say, how many options positions would Dan say he has on a regular basis? An interesting question, Dan. Inquiring minds want to know. Right now, open up your brokerage screen. How many positions do you have on, and how does that compare and contrast to your regular situation?
I got 2 of them open right now, as a matter of fact. In my investment account, I've got 1, 2, 3, 4, 5, 6, 7 option positions, and was looking to add another one. And right now in my trading account, I've got 1, and that's because I've been working really, really hard on the training that we're having tonight. Although if you're watching this next week, because we're recording this a week earlier, then it's not tonight. It was 7 days ago, because we're rolling out our in-person event, our Smart Trade Summit, that's happening in June. And man, I've just been going crazy over here. So all I can handle in my trading account is 1 position. But when my hands are a little bit less tied with content creation and that kind of thing, it can be more, like, especially during the heart of earnings season when I'm trading total earnings domination. It's not uncommon to have 5 to 10 positions in my trading account in addition to the investment account.
Dan, you forgot all the Shiba Inu you're sitting on, though.
Oh, yes, indeed. Yes. Any token that has a cartoon of a dog as the mascot, I'm in with both hands.
All in, baby. I just did a quick check while we were talking. I have 6 open positions right now in my active trading account. And that's because one just got filled as we were talking. I was playing around with a little bit of UVIX post Powell here. So they just filled me while we were talking here. So that's why that's up to. That's usually a little more than I have going on during the active trading week. But, I have a lot of shows to put out, so it's hard to babysit all this stuff. So I try to do things that I could mostly, not quite set and forget, but not have to manage minute by minute throughout the day, Dan. So, and then that doesn't count, obviously all the Shiba Inu, and then also all of like, the long-term stock and that kind of, that's a different thing. We're just talking about kind of trading fun stuff here for the show. So there you go, listeners. That might be a good question of the week. How many options positions do you normally have in your account? That might be a good, fun cue to put out there. Unfortunately, that music means we've come up against it. Dan, you survived another doubleheader. How was it? Did you have fun?
Oh yeah, it was good. Too bad we're not going to do it next week, which is unfortunate. You guys will be hearing this episode next week if you weren't listening live, and but we'll be back live for reals in 2 weeks.
That we shall indeed. In the meantime, maybe next week if they miss our voices, they want to hear you, Dan. Where should they go? What should they do?
Always reachable at markettaker.com. Register for one of our upcoming online trainings at markettaker.com/reg, and get a chance to meet me and John in Sonoma County in June, because we're doing a class then, and we'll be talking about it in some of our online trainings and how you can sign up for it.
There you go. Check it out, markettaker.com. Don't forget the second T for Theta. It is going to do it for us on this doubleheader Education Wednesday. I will be traveling next Education Wednesday. Don't worry if you're on the on-demand side. This show will be hitting next week, so it won't be any disruption to you folks at all. Of course, if you're listening this week, coming at you tomorrow, of course, we'll have episode 2 of the option block for the week with our buddy the Flow Master over there. Then heading on over to CME Land, talk about some futures options and some vol there on This Week in Futures Options. Friday, of course, Volatility Views. Who's going to join me in the guest hot seat? Got to tune in every week to find out. It's always a fun rotating cavalcade of stars over there on Volatility Views. And then after that, exclusively for you pro folks, because we like you, coming back with a little bit of the old options oddities. And then again, I'm going to be traveling a lot next week, so the live schedule is going to be kind of difficult. I may not be able to make the option block on Monday. It will still be going on. It will still be live, just perhaps without me. When the cat is away, the mice will play. So I look forward to hearing what comes out of that one. No live boot camp next week, and then we're back again in 2 weeks. Another live episode of Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.